All right, well, I make it 7 o'clock by my watch, so I think we'll get things underway. A hearty welcome to all our Who Must Bulletin members for our 4th Who Must Bulletin webinar. We are delighted to have you all here. My name is Darren Wilson. I'm the editor of the Who Must Bulletin. I'd also like to have a big shout out. I understand a number of property cycle investor who receive our weekly blog have actually upgraded specifically to attend this webinar. So I'd like to say thank you very much to you guys for being here as well. I hope you get something out of it. A bit of housekeeping before we begin proceedings. Everyone's on mute. That's to ensure a seamless and enjoyable stream. You will notice down the bottom there's a chat function. If you click that, you can put in some questions that both our speakers tonight may elicit from you. We will have about 15 or so minutes near the end of tonight's presentation to answer some of those. I will do my best to try and find a number of questions to pose. And apologies in advance if you miss out. Time is not our friend tonight. And also stick around because we will be having, for you guys only, a very special offer. I really do think that you would get an awful lot from it. So please make sure to stick around to see that. So without further ado, we're going to travel across the world and introduce our very special speakers tonight. Hopefully he's on by now, but it's a good morning in London to PSC Director and Co-founder, Mr. Akhil Patel. Are you there, Akhil?
I am. Good morning to you all. Delighted to be here.
Wonderful. Thank you, Akhil. And now the wonders of modern technology take us to Jakarta, where it's a sunny afternoon, I've no doubt. And our other special guest for tonight, also Director and Co-founder, Mr. Phillip J. Anderson. Phil, how are you?
Hi, Darren. I'm as grumpy as ever, mate. Okay.
Excellent. It's exactly what we needed tonight. So
Yeah.
thank you. Thank you. Phil, we might as well actually kick off proceedings with yourself. I understand that you have some very strong opinions about what happened not only in 2022 within the markets and real estate in general, but also about how 2023 has begun and the type of year you're expecting in the stock market. The floor is yours, Phil. I'm sure that we'd all love to hear your thoughts on that and more.
Thanks, Darren. Let me go back a bit, really. You're probably, if you're new to this, you're probably not going to believe what I'm about to say. I've been doing this for 30 years now, close on, and I can count on basically one hand the people that really go through and have gotten this. Those who've maintained the links with me, and it really isn't, despite what you may believe, it really isn't that many, have done very well from this information. I myself, I've long since retired, and if you take Buckminster Fuller's definition of wealth, I don't have to do anything. I can stay in bed all day and I'd still get paid. But I have no ambition to be the richest man in the cemetery. So I keep working and share the knowledge. Now the question you really want to think about, what I ask all the time, is it really, how do you know what's coming next? Is it really possible to forecast the next 6 months, the next year, the next couple of years, the next decade? Now, don't get me wrong. I've got no idea what's going to happen tomorrow, and I don't forecast that way. But there is a sequence to events, and it's quite scientific, and it's all based on earnings. So let me just demonstrate a couple of things. I'll just take you through a couple of scenarios, and then the other guys will show you what we actually do. But if you do end up subscribing to what we do, I can prove to you the following, and it's all based on earnings. And before we get to earnings, there's one more thing I wanted to say. You have to come to understand that the economics profession and the economics faculty itself at all universities has been corrupted. There is a book you should read. It's called The Corruption of Economics by Fred Harrison. Oh, he was the editor, I think, and Mason Gaffney. Make sure, if you do nothing else for the rest of the year, just my suggestion to you all is get educated, and you get educated this way. So let me say this: it's all based on earnings. Now, to give you an example, certainly if you're in Australia, you will have seen that one of Australia's biggest banks, Commonwealth Bank, has recently been in the new highs list. Now that already tells you an awesome amount about what's coming next. So, for example, in 6 to 9 months' time, Commonwealth Bank is going to report higher earnings. That's why it's breaking into the new highs list today. Economy, real estate does not collapse when a major bank is making new highs. Now, let's assume the price of Commonwealth Bank is about $110 per share. Let's assume, for the sake of an argument, it pays about $10 or $11 a dividend per share. If you think about that, all based on earnings, that means if you buy one share of Commonwealth Bank, it's going to take you about 11 years to get your money back. That's the earnings position. That's what's called price earnings ratio. Now, the important thing to understand, and nobody gets this, land also has earnings. You mightn't see it, but it does. You put a house on it, it has slightly more earnings, but it's the land itself that has the earnings, not really the house. Over hundreds of years, perhaps longer, land has tended to go up. The earnings have tended to rise about 5% a year, which means roughly that generally you're buying land anywhere up to between about 14 to 17, sometimes 20 times earnings. Now, once you realise that the earnings of land are capitalised into a price which you're forced to pay, that does tell you that you must get a real estate cycle. You absolutely must. Once you know that, you can then, when I did the research of all the US history and UK history and read a few other books on it, when the earnings of land capitalise into a price, and that price is permitted to be bought and sold as a tradable commodity, we must get a real estate cycle. One, it's based on earnings, and there's been, a number of other people, Homer Hoyt, Roy Wenslick, and Fred Harrison, a number of others, then began to observe throughout history that once we know we must get a real estate cycle, the actual path of that, the path of that real estate cycle will go like clockwork. Now, I wrote a book on it. I put it in the book, Secret Life of Real Estate and Banking, on page 360. And I should point out, I quite deliberately, I don't put any fancy slides with my talks and stuff. There's just an example. That's how the clock goes. It's on page 360 of my book. That is something you should read, okay? I don't clog up my talks and things with slides and everything else and I'll get all fancy and technical. You don't need, in many ways, at least for me, you don't need that sort of thing. You can just commit that clock to memory and you will know that the real estate cycle goes like clockwork. So from the beginning, the higher rent, once we get the beginning, which we happened around 2010, 2011, 2012, paradoxically, it doesn't look like it will happen, but higher rents capitalize into higher prices. Once you get higher prices for established buildings, then it's cheaper to build, and then the real estate cycle kicks off. That was 2013, 2014, and around it goes. We're now in the second half of the real estate cycle. In the second half of the real estate cycle, we know that tech stocks do worse relative to the banking, insurance, and real estate sectors. So that, it tells you that over the course of the coming cycle, as we go into the extreme of the cycle, we know that commodity prices will do well. We know that banks and real estate sector do well. So you then gives you the ability to actually test whether that's going to happen. And you can see Australia's Commonwealth Bank, like I mentioned at the start, breaking into all-time new highs. That's the banking stocks do well. Now, see, this is where you simply have to get the sort of information for yourself. You have to be able to work it out for yourself, because the economics profession has been corrupted. They don't know how this cycle is going to work. So they will tell you, as they did last year, when interest rates go up, house prices must collapse. And it's just absolutely plain wrong. I think Akhil's got some information on that to come, so I'll leave that to him. But the cycle will go like clockwork. And I can tell you, if you've read my book, you go into chapter 20 and it gives you a couple of things to look for. It tells you to look for the yield curve, taller buildings, and it tells you to look for the price of copper. And then this is what also nobody gets, but the only place you'll ever be taught it is the sort of stuff that we're doing. You will start to see a play for copper assets. And this is the sort of thing you're starting to see on the Australian stock market. You've already seen there are two stocks on the Australian stock market, copper plays, that have been taken out by larger corporations. So BHP is trying to get its hands on an Australian copper miner, and now Newmont in the US trying to buy Newcrest, which everybody thinks might be about gold, but it isn't. All right, they're chasing copper now. Why would they be chasing copper? Because traditionally, at every single, into the extremes of every single real estate cycle, copper prices explode. Now, what price that information? You know, the only way you'll ever see it, because other people, of course, see some of the stuff that's going on, but they can't place it in the overview of a real estate cycle. And it's always the same. Every real estate cycle goes the same way. Now, that's enough about real estate. I've been doing it 30 years. I've grown a bit bored with it. I've become a bit grumpy, right? So, you know, nobody believes it. I'm telling you, if you get onto some of the information, you have a substantial advantage, because nobody else is seeing this stuff. You get the ability to put all of the information into a sort of like a cyclical event, which you can partition in your brain, and you get the chance to see what will come next. So leads me to the next thing, and you will find what I'm about to say. You will find it's completely off the wall. You will find this a little bit more difficult. Property share market economics, me, Akhil, Darren, and all our staff. We have a document. It's called a financial timetable, and this financial timetable demonstrates, based on some particular timing, it demonstrates how the US stock market moves within the 18-year real estate cycle. And so the US stock market is only ever likely to do certain things in certain years. Now, you take 2022 was always going to be a down year. Now, what price is that knowledge? First up, if you actually know what's coming, it just takes all the stress away from what you're trying to invest in, because you have a good idea of the cycle. And here's something you might want to look at. It's sort of stuff that all of the property share market economics people, all of our members, knew what was coming last year, or at least at the start of 2022, knew what was very highly likely. Do this. You take 2022, every 7 years, the Dow, the US market, tanks. It's just something that happens. All right. And 7 years is a very important number, because it's 360 weeks. 360 weeks is one circle or cycle. So you go back, you look at 2015, you look at 2008, 2001, 1994, 1987, the further back you go. They were all difficult, not so much difficult, but they were all down years. People don't like down years. So when you get down years like that, everybody scrambles, but you could have seen that coming, right? Now, the financial timetable, I do not discuss that in public. The only way you're ever going to see it is to become a member. And if you do become a member, you get access to the classes that I've run practically every year now for at least 15 years on those financial timetable and how it fits within the real estate cycle. It's just not something I discuss publicly. So that just gives you a bit of a scenario about what I do and how we handle the real estate and stock market. I think Akhil and I and Darren, some of the very few people in the world that actually do both stock market and real estate. Most people just study one or the other, but it's absolutely critical that you understand both. So I'll leave my bit at that. I hope when you were looking at that, I didn't want to see people crossing their arms and moving in their seats, because I know it's hard to believe. I know that most people are conditioned to thinking things are random. I know that. Well, I won't go on. I won't continue. I'll leave that there. I'll leave it all there, because I'm starting to ramble now, getting even more grumpy. Thanks, Darren. I'll hand it over to you and back to Akhil, and Akhil can explain and go through some of the stuff that I mentioned.
Thank you, Phil. A great primer, and I know that everybody still carries the weight and the scars from 2022. It's still fresh in our minds, but as Phil detailed, just how incredibly refreshing and empowering it is to not even have to listen to that noise and simply look at your real estate clock and know what's to come and just wait for it to happen. It's a truly liberating feeling. I think Phil summed it up quite well. Our next speaker is Akhil Patel. So he's in London currently. Akhil would like to dive in a little bit further on what Phil's mentioned, and he'd also in particular like to do a examination of our 2022 stock market roadmap, how it performed relative to our forecasts, and also some ideas on what 2023 will bring. Akhil, if you're there, the floor is yours.
Brilliant, Darren. Thank you very much. And good morning once again. So I'm going to just sort of briefly kind of pick up on what Phil had said, and then sort of demonstrate how we put things together. And I've then set out some thoughts for 2023 and the years beyond. So sort of I think we really start in December of every year. Phil and I sort of get together either via Zoom or in person, and we start sort of discussing how we think the coming year is going to play out. Now, I think Phil made a really important point at the end of his introductory remarks, and that is that there are many people, there's an entire industry of people in every country in the world looking at the stock market and trying to analyze it and trying to forecast it. And there are, maybe to a lesser extent, but still quite a large industry of people trying to forecast real estate markets. Some of them may even, to a certain extent, understand shorter term real estate cycles, and indeed to a greater extent than I do. But there is virtually no one that tries to put the two things together. And to my mind, the 18-year real estate cycle is based upon hard economic science. People say that economics is not really a science. May be true in the way that economics is practiced in universities and so on. There's a deliberate blindness that is inculcated into economists, and it is indeed very well set out in the book that Phil mentioned, The Corruption of Economics. I might just, as an aside, make a quick plug. I've recently completed a book which should be published in the middle of the year, and I have a chapter devoted to this subject: why people don't see the cycle. Nonetheless, so we don't have many people who understand real estate cycles. There is a hard science, and it is based upon how we treat land being the most important asset in the economy. It's the sort of thing that you can't do without. Everyone has to be located somewhere to live, to work, to play, and to do that, they do that in certain locations, which gives land its value. And it being the kind of the ultimate scarce asset, because there's only so much land to go around, particularly in specific locations. It's also the asset that gets most speculated in. Then banks get involved. They create money for people to acquire land, and you have real estate cycles as described by Phil. So we look at real estate cycles, hard economic science, and we also look at stock market cycles and commodity cycles, and we sort of look at where we are in each of those, and then we put together our annual forecast, 30 or 40 pages of charts and analysis and discussion of where we are in the cycle, the sort of context, what's going on in the economic and political sphere, which might influence how the following 12 months might play out. And then we produce a forecast curve for our subscribers. If we can move to the next slide, please, Theo. So the first thing, of course, is to set out where we are in the real estate cycle. Now, those of you who have been reading Boom Bust Bulletin for any length of time will, I hope, understand where we are. But to those who are relatively new to this, just very briefly, each 18-year cycle, it's not just something that happens once every 18 years. You can, if you read Phil's book, if you read the works of Homer Hoyt and Fred Harrison, you can break it down into discrete stages. And so typically you have 14 years up and 4 years of crash and recovery and quite difficult times. And those 14-year periods of expansion can themselves be subdivided into roughly 2 7-year halves, interrupted by a mid-cycle recession. The first half begins a cycle. It's when the news is really quite negative. Things seem quite slow. And people really wonder if we are actually recovering and going into a new cycle, or if we are still in the aftermath of the old one. The mid-cycle recession serves a very interesting purpose. In addition to it being a period of some difficulty, but not as difficult as the crisis that you get at the end of the cycle, it also shifts the narrative in people's minds. They it almost breaks people's memories into two halves. And the first half of the cycle is, in their minds, part of the previous area. The second half of the expansion is where they think actually things are this time is different, is essentially the phrase that a lot of people use. And so the second half is much more speculative. People are much more willing to jump into the markets. You get a lot more building, you get a lot more construction, you get a lot more speculation, you get a lot more debt created. And that eventually builds up and up and up into a land boom, and then into a final couple of years as depicted just into the peak of really rampant speculation. And if you think of, in previous cycles, a period from about 2005 to 2007, or the late 80s, particularly in places like Japan, or indeed the early 70s, those were periods where really things were going way over the top. Then you get the peak, and then and people say, oh well, prices are never going to come down again. This is a new era, it's a permanently high plateau. All the things that you've seen through history, brilliantly documented by Phil. And then you get the crash and the crisis, and people say, oh, we couldn't have seen that coming. It's the first time that we've ever had a crisis like this. How do we sort it out, and how do we do things that we never have, that it never happens again? And then around we go for the next cycle. So we look at that, we understand where we are in the cycle. The yellow dot indicates where we are. So notice the commentary is around sort of quite negative sentiment at the moment, and yet what we're seeing, quite contrary to what people are saying, is something quite different. So that's the context in terms of the 18-year cycle. Can we move to the next slide, please? These are just depicting the phases, so you get the sort of the 4 phases, just giving them names. The next thing we look at is the long cycle, the Kondratiev wave, the commodity cycle. It's a 55 to 60 year wave of commodity prices, 25 years up, 25 years not down in a straight line, but a declining trend. And this is very much associated with both commodity prices, but also capital investment, technology, and even social disruption and international disruption as well. It was discovered by an economist in the 1920s in Russia by the name of Nikolai Kondratiev, after whom this cycle is named. He was asked, incidentally, by the revolutionary authorities in 1920s Russia to identify the final expiry date of Western capitalism. And he amassed an enormous data set, which must have been a really vast undertaking. In the pre-computer era, you had to actually travel to libraries to find data, and he put it together, and you had to manually analyze all of that. And he discovered this cycle. And actually what he found was that, yes, indeed, Western economies go through these longer phases of development, often linked to technology. And they peak, and then during the up phases of each of those waves, you get a lot of it's not so much invention, but the rollout of application of technology to the economy, which leads to a lot of capital investment. It also tends to mean that recessions are shorter than they are in the downside of the wave. It also means a lot more disruption, because one effect of technology is to disrupt the economy. New industries do very well, but old industries do very badly, and so there's greater inequality, and people are very upset about that sort of thing. It also means that internationally, a lot of countries are vying for access to resources, which are great powers need access to resources to power their economies, and they want to dominate the terms of international trade, and so they're quite disruptive times. The current long cycle started around 2000, and so should peak around towards the end of this decade, and again is a explanatory factor to all of the things that we've been seeing since 2001. We've seen significant shifts in the international system, particularly with China joining the WTO. We've already had one commodities boom. We're potentially on the brink of another one. We've also seen a very significant change in our societies, and we've seen huge amounts of technological innovation application, particularly the internet, mobile technology, the cloud computing, the blockchain, asteroid mining, additive manufacturing. The list goes on and on. It's been a highly disruptive period over the last 20 or so years. So that's a second sort of feature. In addition to that, we also look at various stock market cycles. Phil mentioned the financial timetable, which shows how the stock market moves in 18.6-year cycles. So in relation to the real estate cycle, even though the person who developed it, a legendary Wall Street trader called W.D. Gann, didn't understand himself the real estate cycle, but it certainly timed with it. In addition to that, there are also 10, 20, 30, 60, 100-year stock market cycles that we put together to analyze where we are and what potentially might be coming around the corner. Next slide, please. And then, having done all of that analysis, we produce forecast curves for the Dow Jones, for the NASDAQ, for the UK FTSE, and for the Australian All Ords. And now, I mean, this was the forecast curves that we issued at the start of last year. And you'll notice, consistent with what Phil was saying, that, the narrative at the start of 2022, and now, I mean, a lot of things have happened in the last 12 months. And people might say, oh, well, we knew that there was going to be lots of inflation, and we knew there was going to be all this disruption. That's actually not true. At the start of 2022, people were of the view that we were now fully out of lockdowns, that global supply chains would be recovering back to pre-pandemic normals, or a new normal, but certainly they would be recovering. There would be a transition back to a low inflationary environment. Famously, the head of the Federal Reserve talked about inflation being transitory. Now, I know there was a bit of skepticism, but certainly not of the way that things turned out. It appeared that China was going to also open up again, and so on. Our forecast curve pointed out a few things. Can you go back to the previous slide? It pointed out a few things, and in the commentary around it. One was indeed the 7-year pattern that Phil mentioned. Every 7 years, the US market seems to have a bit of a tantrum, for whatever reason. It's not necessarily something to do with the US. It might be something to do with us. In 2015, for example, it was to do with the China devaluation, and it caused a bit of a panic around August of 2015. But nonetheless, cycles come in and markets turn down. We also pointed out that the second year of each decade tends to be quite a disruptive year. And that is potentially a reason why markets might come down. Then, of course, we did feel that the inflation side of the story might cause a few things to to change. I didn't expect inflation to take the course that it did, because I didn't necessarily anticipate that we would have the war in Ukraine, for example. So we called for a low around second or third quarter of the year, and a low in the autumn, so around the start of October. Now, typically our forecast curves are fairly consistent, but some are slightly more bullish than others. So in the optimistic scenario, we'd have a slight dip around the middle of the year and then sideways to the end. In the more negative scenario, we actually saw quite a significant fall into the autumn. If you then plot the actual curve against the forecast on the next slide, you'll see that actually it tracked extremely closely the more negative scenario. The low for the year we called exactly, so it was at the beginning of October or the middle of October. In fact, for me, the really important low was the one in the middle of June. It wasn't the lowest low for the US markets, but it was the low where sentiment was at its most negative. And then we forecast a recovery out of the October lows, and that was consistent with market action in 2002, in 92, and in other previous cycles that we were looking at. You will note, of course, that the sentiment in October was extremely bearish. We were on the brink of collapse. Sentiment is still relatively negative now, but I don't know if you've noticed a bit of a shift. It's become a lot more positive compared to where it was a couple of months ago. Next slide, please. So that brings us to what's the outlook for 2023. Now, this is the last thing I'll say before we can we'll hand back over to Darren and we can do some Q&A. The outlook is rather dependent upon how people view inflation and where it's going, and because that, of course, determines what central banks will do in terms of interest rates. The other major factor, I mean, I think it's probably more relevant to those of us who live in Europe, is the ongoing issues in Ukraine and the possibility of some kind of spring offensive by the Russian army, and some resistance by the Ukrainian army, and what that might mean for further disruption in energy and so on. Now, it seems to me that we've spent the last 12 months trying to work out how to get energy from different sources and so on. And so it's unlikely, barring a significant escalation in the war, that it will have quite the same effect on the global economy as it did at the start of, the end of February, the start of March, when the Russian army went into Ukraine. And this, I think, the course of commodity prices will also be significantly influenced by what happens to the US dollar. US dollar had an enormously strong year last year. That was partly because, there's a number of reasons. One is and I noticed a question coming up about USA and declining and so on. One of the reasons that the US dollar was strong is because in a crisis, people want dollars. And so that is part of the answer to that question. And then the other reason is that the US was probably the central bank that decided it was going to get a hold of inflation first, and so really pushed up interest rates. Now, you'll notice that when interest rates went up very significantly, particularly in, I think it was in April, May, June period, it was a very significant surge in interest rates, in some ways unprecedented, but, if you study financial history, there's very few things that are unprecedented, to be honest. People were saying, well, high interest rates is going to have this enormous effect on the mortgage market, which is true. It does have an effect on the mortgage market. It's going to collapse house prices. And we put out some analysis around the middle of last year when we looked at interest rate hiking cycles since the end of the Second World War. There have been 11 in the US. And in all of those hiking cycles, in 10 of them, house prices have risen. And over the course of those hiking cycles, the average rate has been about, the average gain, sorry, has been about 30%. And in the 11th hiking cycle, house prices went flat. Now, the reason is where we are in the real estate cycle. Typically, central banks are raising rates during the expansionary phases of the real estate cycle to try and rein in inflation or for some other reason. And yet the real estate cycle continues. And so the primary piece of evidence and the primary piece of knowledge that you need to know to make a forecast is where we are in the real estate cycle. And that is something that pretty much no one gets. Now, speaking of where we are in the real estate cycle, we use that as our basis for making forecasts. As I pointed out at the start of my talk, we are in the second half, the expansionary half. And so really what you should be paying attention to is how much of a construction boom is going on, because we are in a land boom phase of the real estate cycle. And if you actually look at the news, you can see all of the evidence for this, the enormous amount of construction going on in the Middle East, for example, and the announcements of ever taller buildings, the enormous amounts of energy and other infrastructure investment in Europe, in America, in Australia, and other places. All of these things push up land prices. We get higher land prices, it induces further construction. People, when prices start to go up, people scramble to get onto the property market. They might buy smaller places. They might have to put more of their savings into a deposit. They might have to get their parents to help them out and so on. But this is what happens typically every cycle. In addition to all of that, I actually think inflation will come down. It will take another very significant shock to keep inflation rates where they are, because it will require further disruption. Inflation will naturally come down as businesses realize they can't keep pushing prices up. And one of the reasons why they felt they could was because people wanted to spend. People wanted to spend because they saved a lot of money in lockdowns. And so they were quite price insensitive. We also had this sort of feeling that we need to go out and spend, having been denied the opportunity to do so for 12 months. Again, it's not really the way that people think about things. As I said, property prices are actually increasing in most places. Now, you might find some stories about prices having come down over the last 3 to 4 months. That's true. I mean, interest rates is a big factor in a property purchase. But if you look at things over the course of a year, I don't think making judgments based upon the slowest months at least from the point of view of the Northern Hemisphere, the slowest months of the year for the property market is really a sensible way to forecast. So 2022 was an up year for property. I expect 2023 to be the same. Construction boom also means a lot of demand for employment. So construction employs a lot of people, and that feeds in on itself in terms of increasing demand in the economy and therefore growth. And also what we're seeing as a consequence of all of the disruption, the pandemic, people retiring, people leaving the workforce, is there's an enormous shortage of workers in many countries, and that pushes wages up. Wages rising has an effect on inflation, not as high as people make out, in my view. But what it does do is enables people to have more money in their pockets, and therefore ultimately to spend more money on real estate. And so that is how a land boom propagates itself, despite the fact that the news is quite so negative. So that is where I think we are in 2023. Beyond 2023, again, it's a continuation of the property clock. So the land boom begets higher prices, which begets higher volumes of lending, which means lots of additional activity in more marginal locations, which is where things go totally over the top and banks are overexposed. And the other thing which is probably even more of a feature of this cycle than previous ones, is how global it is. It's global in the sense that housing markets are increasingly synchronized. So they move together, they go up and down together. This is based upon some pretty detailed research carried out by the International Monetary Fund, but also it's to do with the fact that capital moves across borders And so if banks don't have the ability to lend in one market, they'll go and lend in another. And then it has feedback loops back onto the original market. So we have a global boom. I think it's very evident if you pay attention, and I see the continuation of that into a potential peak around the middle of the decade. I will probably stop there, Darren, and hand back to you.
Akhil, thank you very much for that. You continually amaze me in just how much information you're able to disseminate and provide for us in such a short time. The good news is, of course, your talk elicited quite a lot of questions in the chat, which it means the attendees are starting to think about things, which is fantastic. I just ask everyone here just to bear with me just for a couple of minutes. Akhil outlined very well, I think, some of the challenges that we see for 2023 moving on, but also some of the opportunities as well. And I'd just like to take this moment just to quickly show you precisely how property share market economics are helping prepare our members to answer that type of question moving forward. Tia, if you can put up the member slide, please. Thank you very much. So I'm just going to speak to this just for a couple of minutes. This is what the PSE membership does offer. Akhil showed you a great example of the 2022 stock market roadmap. That's an annual roadmap that we release approximately January every year. But for this year, for the first time, and I'm very excited about this, not only will members get the 2023 one, which was released in January, we're also doing a roadmap that will take us from 2023 to 2026. Now, if you're someone who likes to or wishes to invest with the real estate cycle, you have a 3 to 4 year window for your investments, then having that kind of guide to enable you to time your investments over that period is absolutely invaluable. And I can't wait for this to come out. We're very close to releasing it. If you're a commodities investor, Akhil has also done many forecasts out to 2026, particularly for gold. It's a matter of record on our website that some of Akhil's forecasts have been exceedingly accurate over the last 12 to 24 months, particularly with gold. And again, the fact that you have a commodities forecast and now a stock market forecast now to 2026, I mean, if you combine them both, I mean, that's an extremely powerful tool, and that can give you a huge market edge, in my opinion. We also do quarterly economic indicator reports for our members. It's a combination of publicly available information, plus a lot of proprietary indicators that you will find nowhere else but property share market economics. And they give you a chartbook style reference point as to where we are with the cycle, what all the key indicators are telling us, and where we may be heading over the next quarter or two. We get weekly market commentary and emails, both from Phil and Akhil, occasionally myself, just to check in with our members to make sure that anything that's pertinent to their learning and research, or identifying key turning points according to our property cycle clock. People get weekly commentary on that from the team. We're going to start looking more now that we're into the second half, well into the second half of the cycle, on stock sectors. We want to be looking at the most bullish setups in the best sectors that we expect, given real estate cycle history, should be outperforming for the remainder of the decade. And we will obviously give you examples of the setups so you too can learn the best times to buy and sell for them. And of course, last but definitely not least, Phil is devoting almost all of his resources now into the study and research of one W.D. Gann, who is one of the most legendary Wall Street traders of all time. And that commentary for our members is exclusively for them from Phil, and they've garnered an awful lot of positive feedback from members. Q&A session, and we've got quite a few questions, which I'm delighted about. I do encourage, if you've got anything on your mind right now, you will rarely get time like this with Phil and Akhil in a year. Trust me. If you've got anything you want to say to them, hit the chat button down there. I will do my best to go through the questions we've got. But Akhil, I'll start with you because you've elicited a lot of these. I can see the way people's minds have been thinking here, and I won't say names to protect the innocent, but I'll just summarize. A lot of people are stating that prices in property, Australia, Canada, the US, the UK, they're still all coming down, and people are throwing out, 15%, 20% type things. How does that fit in with your view of the cycle?
Well, how does it fit in with my view of the property market? So, I mean, there's nothing about the cycle to say that prices will rise every single month or every single quarter in every single location on the planet for 14 years. It's not how it works. Property prices are affected by local factors. So a country might have, might be going through a difficult time, and it might have unusually high unemployment or something in the course of the cycle. And so it may have lower prices. And it also means that some locations are favorable because people are moving there, businesses are relocating there, there's not much available supply, and prices go up in response to that sort of particular development. And similarly, people might be leaving a particular area and prices are going down because there's more supply than there is demand. So there are sort of underlying dynamics. Now, it is the case for most property markets at a national level. If you look at the price at the start of January 2022, and then compare to the latest available data in November or something, I don't think December data is out, that in Australia, Canada, the United Kingdom, the United States, prices were higher, despite the enormous disruption that we've had. Now you can say, okay, fine, well, they went up into June and then they've started coming down. Yes, the market has responded to a certain element of disruption. That is true. But my point is that I don't expect that to continue. And actually, I expect that prices will be higher at the end of 2023 than where they are now. And so that, by definition, is another up year. Now, that doesn't mean that every single location for it that you might want to buy property in is going to go up. I mean, whenever you're buying property, you have to do particular research on that specific area. I also think, I've noticed a lot of the information in the UK saying property's down for sort of 5 or 6 straight months and hasn't really come down very much. And certainly if you are trying to buy a property in my area, you're certainly not paying lower prices than you were even in June or July or even in October when we had a bit of a lunatic prime minister who decided to try and blow up the economy. So I think you have to be quite careful as to what parts of the overall sort of news you get and match that to the reality of what you're trying to do in a specific location. It may be that in some locations things have come down, and certainly California is a good example. So San Francisco prices have come down quite significantly in 2022, and that is partly because, as I said, there are specific factors. When interest rates go up, the value of Silicon Valley companies, some of which don't have much current earnings, their share price is based upon the prospect of future growth. They come down quite significantly. They then have to lay off workers and so on, and also disruptions to the way that office work happens. People can work remotely also has an effect. So there are local factors, but overall, I think prices are rising in my view.
Excellent, thank you. Question here about, is there a correlation between mortgage rates and house prices, and your thoughts on the interest rate cycles?
Darren, before you go in, sorry.
Sure.
I just add a very quick comment there. So the people suggesting house prices coming down everywhere. House prices in Asia are going up. Singapore prices are going up. House prices in the US are up. There are some specific location areas where they've been down. You are looking at things the wrong way. The abnormal year was not and is not 2022. The abnormal year was the money pumped in 2020 by governments panicking that don't want another collapse. So the areas that doubled in price in that year or up 50%, they have to pause. You have to have some reasonable expectation that is going to happen. But I can tell you, history demonstrates, when you look, certainly go back to 1955, there isn't one era, and even you go back more, there isn't one era when interest rates were going up and house prices crashed. Okay, now you have to expect a pause in some places where you had these massive rises in the first place. Now they've got a pause. But in most places, in Dubai, Middle East, Singapore, prices are practically doubling. So anyway, I just thought I'd add that in. View this within the context of the real estate cycle. Okay.
I mean, this, to be honest, this underscores why I think you need to have contact with us, because I mean, we really sort of point out things quite differently to other people. I think some of these questions are related. I mean, some of these are not. I think the factual, there's not, prices haven't been coming down in Australia since February. I don't think that's true. It might maybe in certain areas, but not overall. No.
Well, the latest ABS data had new construction starts for December up 18%. So,
yeah.
If that next quarter comes out and that remains, that's the bottom. The bottom of the Australian market was December 2022. Sorry, I was just saying to you, Akhil, about the rates. So your expectation for interest rates in the US, will they start to decline, remain the same? And how
I mean, this is the big question for 2023, and I think there's a lot of expectation that the Federal Reserve will start to reduce rates. He kind of, the financial industry loves to speculate about what the Federal Reserve is going to do, and it's a massive sort of news story. I think interest rates are going to come down, or maybe if they don't, well, it's a bit hard to say. It sort of depends on a few different things, and inflation might not be the only thing. So inflation, I think, is coming down. I think it's probably the headline numbers will probably fall quite dramatically, barring some additional major shock that we haven't foreseen. Whether that leads to a reduction in rates, or they just hold rates steady where they are because the economy is adjusted to it, I don't know. I think the sign of it will be with the dollar. So the EU is tightening interest rates. If the dollar is pausing, that will lead to a fall in the dollar and a rise in the euro. And so I think that will be the indication of where that's going. The other thing to note, actually, is we talk about the US and Europe, but really China is probably in some measures the world's largest economy. And China is definitely flooding its economy with liquidity as a way of getting growth going again and trying to recover from the sort of quite ridiculous levels of lockdown they've had over the last couple of years. And so that, it might mean that the US central bank is not quite as in control of events as it can be. So if there's a lot of global liquidity, that will, it might keep inflation a bit higher than they wanted. It might mean that their use of interest rates doesn't have quite as much effect as possible. Lots of liquidity means lower rates overall, though.
Right. Phil, if you're still there, just a quick question for you concerning US stock markets. Do you believe they bottomed last year? And
yes, I do. Look, this is where I start to get really grumpy all over again, right? It's absolutely clear. I know from the questions coming in, you haven't studied your history. So you just go back and have a look in 2002. And I lived through it. In 2002, the NASDAQ was down 79%. It completely collapsed because its year ended in 20 years ago. Absolutely everybody thought the world was going to end. They did. And look what happened. After 2003, the NASDAQ just took off, even more so what the Dow was doing. And then by the time we got to 2006, absolutely everybody was trying to work out what Paris Hilton would do next. Okay, I'm telling you, this is coming again. This time, by about 2025, we'll all be trying to work out what Elon Musk is doing. All right, and we're going to be fixated on the people who are rich. In 1993, from the prior recession, particularly in Australia, if some of you are old enough to remember that, absolutely nobody thought Australia would recover. The street where I had my office, Flinders Lane of Melbourne, the entire street of Flinders Lane was empty. There was only one building in it that had any occupants. That was Ross House, and they were government sponsored. Absolutely nobody thought Australia would recover, especially Melbourne. But look what happened. That was the absolute best time to buy real estate, which my family and I did. Okay, it's allowed me to retire. So stop going on about some of the crap that you're seeing in minor trends, right? You have to know your history. In 1982, interest rates were at 21% in the United States. Mortgage rates were at 17%. Yes, despite the fact that they were that high, the previous 7 years, property prices had doubled. Then we had the pause mid-cycle. If you go back to 1972, they were tough years. Now, in 100 years ago, and people think this isn't relevant, but it's more relevant than ever because this is how the cycles work. In 1922 and 23, coming out of 1921, people again thought the world was at end because we'd had a very rough First World War. People have been speculating and storing commodities, and then commodity prices collapsed, the economy tanked, and absolutely everybody thought that was the end of the world. And then in 1923, 1924, things absolutely exploded because people had had enough of living tough times. They started spending. And in 1927, absolutely everybody was following Rudolph Valentino. They were all in their flappers and they were all trying to work out how to copy what he was doing. There were stunts, aerobatics, absolutely everybody preoccupied. In the United States, we're talking about, things were more difficult in Germany and England at the time because of the First World War stuff. But in the United States, absolutely everybody was just out on an absolute spending binge. If everyone, well, I won't go into a lot of stuff, but it's all in the book, all in my book. You've got to understand your history. There is absolutely no reason from what is happening today. There is absolutely no reason why, as we go into 2024 and then 2025, there could be boom conditions, because that's exactly what's happened in the past. 2003 progressing to 2004, stock market in all-time highs. The same happened in 1992 into 1993, 94 we kicked off again, 82 into 87. They were absolutely enormous speculative years. Okay, I'm going on too much, sorry. I'll forecast for you in about 12 months time, 18 months time, the US markets will be back in all-time new highs.
Yeah, definitely.
All right, last question. I'm conscious of time. Phil or Akhil, you can answer this. It's a combination. How accurate have our past intra-year forecasts been? I think we've had an example of that tonight. And how do you suggest using the roadmap? I think that's a great way to close our Q&A session tonight.
Phil, do you want to go, or shall I? She disappeared. All right, A's on mute. Yeah, so intra-year, look, I mean, I'm not going to say that every year is precisely as good as the 2022. I mean, you have to acknowledge that, you know, sometimes things can happen that throws a forecast off. But I think if you look at the history from about 2016, when I think we first started doing it sort of consistently, it's been pretty strong. I remember we're very accurate in calling the top and bottom of the year. Sometimes the market might flip for whatever reason. So what we've called the top is the bottom, and what we call the bottom is the top. And that's, you know, you can spot that in advance, because, you know, we one thing that we also say is that the forecast provides the areas, the landing zones, or the time frames where a turn is likely to take place. And so 2017 was a good example of that. So yes, it's pretty accurate. How do you play it? Well, you can play it in a number of ways. If you are an investor in the broad markets, you can use that as a way of timing. We provide suggestions on the sorts of stocks and ETFs and other things that do well over the course of this phase of the real estate cycle, and so you can invest that way. And also, one thing that we'll do more of this year is bring up and comment on interesting charts and setups that we think, not as a recommendation, of course, because we're not allowed to do that, but we can say here is something that's consistent with the real estate cycle, and it's got an interesting sort of pattern which suggests that it might make a good investment and for you to consider. And we'll try and have a broad coverage of US, UK, and Australian market. So those are the main areas where subscribers are located. Sorry, can I just make one or two final comments based on the questions? If that's all right before we close. Is that all right, Darren?
Yeah, I'll finish up after you.
Okay. So I think Phil's point about the sort of mentality and the mental shift, I think is quite important. I'm thankful to all those who've provided some sort of anecdotal evidence about what's going on in their areas. I've now just lost the question that I wanted to. Oh yes, so there's a question about apartments and the peak of the cycle and smaller cities and so on. So yes, this is a dynamic. So I mean, property in Melbourne and Sydney are, I expect will continue to go up quite strongly as you get a boom, but you do get the location of most of the activity typically in smaller cities, because the property market ripples out. When one area is too expensive, people look at the next area, and that's where sort of developers go, and that's where the construction is and so on. So population spreads out. I think to a certain extent that's exacerbated by the fact that because of hybrid working and so on, people and businesses can locate in different areas. Apartments typically are the most overbuilt towards the peak of the cycle, so you've got to be a bit careful. And that reason is because high land prices means you need to put more development on a particular site, and so the returns on a apartment project are higher. And you've got a lot of speculative interest, and they put their money into apartments and rent them out and so on. You definitely don't want to be buying apartments where there are lots of other apartments being built, particularly at the peak of the cycle. That will really kill your returns. Indeed, it might mean that the crash in apartments in that area is really quite significant. So be quite careful. Property prices at the end of the cycle don't go down for 4 years necessarily, except if you've bought in a poor location. In fact, in central locations, they might come down quite significantly, quite quickly, but then stabilize as governments start to bail out the system. And I think there was a question about crypto and the crash. I mean, again, assets that have no earnings do very badly in a crash. So I'm not sure, I know there's some crypto evangelists who think that Bitcoin or something else might be the new safe haven. I personally don't see it myself, but we'll take a look at that. But do bear in mind the point about assets with zero earnings in a crash. They can come down very significantly.
Yeah, thanks, Akhil. Briefly, sometimes you need to get outside yourself, and I would urge you, if you do nothing else, just take up the offer. And even if you don't subscribe for years, even if you just do 1 year, you will see the world from a completely different perspective. And I'm quite certain it'll make you a better investor overall. That's the purpose. But I would urge you to get outside yourself and view the world like a bank does. This is really important, because at the end of the day, it's land and bank credit that drive the earnings. And at the moment, the situation is going to be very, very good for banks. When interest rates go up, their margin widens and they make more money. And I don't need to prove that to you, because the proof will be in the stock market. Because if that's the case, the price of bank shares will rise. Now, in the UK's fifth largest bank, Virgin, their stock is going, the stock price is listed on the Australian market as well, the UK, the stock price is now going up. All right, it fell a bit because of difficulties, but it's reversed. You've also got Commonwealth Bank, which is one of Australia's larger banks. I think it's the Australia's largest house lender, just broken into new highs, which I mentioned at the beginning, right? Banks are making money now because their margin, their spread has widened. That means as we go further into the decade, they're going to be creating more credit. And I'm telling you, stop listening to the opinions of everybody else, especially economists. You don't need opinions. Subscribe, and we teach you how to read a chart so that you will know what's coming next, because the market tells you. I cannot be more specific than that, and this is the only place you'll learn it. Thanks, Darren.
Thank you, Phil. No, wonderful summation. People, that's basically our Boom Bust webinar for tonight. Akhil, Patel, thank you very much for joining us for London, and Phil from Jakarta. You guys were fantastic tonight. Thank you to everyone who put in questions. It doesn't matter if they were negative, positive, for us, against us, they were all most welcome. And enjoy your weekend. That wraps up Boom Bust Bulletin number 4. Thank you very much.